is right here. So now what happens? Okay, price comes down here. That's Sunday. Price comes down on Sunday. Starts to push up. Early Sunday morning, Eastern time, right around the London Open, look what happens. Price comes back down again. Can it get to the line? Absolutely not. Starts to move up. So we're starting to form this spike. So as we're planning ahead for the market, what are we doing? We're observing 94.63. What are we observing? We're observing it for reversal types of patterns. What are reversal types of patterns? Well, this W bottom is one, or a double bottom, right? A double bottom is a reversal pattern. There are many different ways to trade it. Some people like to trade above the middle of the W here. I prefer to go down to a 15-minute bar and trade like a 15-minute breakout. I like to look for different things like flags and pennants and whatnot. Okay. I also have this little dipper pattern, which I really enjoy. So if the market is coming down to a support level, I see it moving down again, I want to get in on it so I can make a trade if the risk-reward is right. And the little dipper is based on just a simple combination of prior support or resistance has already been met and held, and I'm trading as the market bounces away from support or resistance, and I trade on the 618 retracement. And my stop is typically below the prior low, or if I'm trading to the upside, if the market moves down and up and I'm trading here, I'll trade above the prior high. Okay, that's an option. But don't miss the real meat of all of this past almost 30 minutes. What I'm getting at is, in order for the market to show you that it's starting to reverse, you are going to have to first develop a plan and an expected pattern. That's number one. Number two is we have to realize the basic underlying thinking. I don't even like using psychology. I think that's a very imprecise word. We have to understand the thinking that if traders were buying pounds down here and they're buying pounds in here, I mean, look at these 2 weeks. Closing nearly on the highs. Very, very bullish. Shaved bottoms. Very, very bullish. So there's major bullish sentiment in here. And then all of a sudden, 1 week, it turns around. So we have to be prepared for this bullishness to come right back into the marketplace. So does this spike show us that it's likely that institutions are getting back in? I would say absolutely it's likely they're getting back in. And then what trading, and I'll boil it down to this, and I'm trying to wrap this up very quickly because I'm right at half an hour and I don't want to keep you pinned to your desk forever. Whenever the market shows a potential sign for a trade, what you've got to do is get to the point where you have an acceptable level of risk, whatever that may be. Because if you think about it, if the market was selling here, so traders were thinking sell, and the market moves up, then they were thinking buy, then they're thinking sell again, now they're thinking buy. What does that mean? Well, what that means is if you let the market get out of all of this junk in here, all of this consolidation and sideways action, and it starts moving up, to me, this is a much more low-risk trade for just about anybody. Why? Well, because if the market gets back into here, what does that mean? What that means is that all of the people who were buying in this area have stopped buying if the market starts to push down. And it actually means that new sellers are coming in.